This is a chart of Altria. It's one of my favorite stocks. I've been trading it for a long time. It is the Marlboro Man and Juul. So they do tobacco. Reason I use them is because their stock goes all the way back to like 1976. I could zoom in on all these and these will be very choppy. But I zoomed all the way out, so it's emphasizing this right here. Um, so yeah, they're a dividend strong dividend stock, which means they don't move a lot. They're not in the paper a lot. They're not in the news a lot, so they don't have these wide swings that have nothing to do with their um, their business plan. They're very consistent because they have everybody addicted to their products. So they're very consistent in terms of their sales and their earnings. So we can see very clearly um, their how their stock moves. So if you remember from last class, then you have the upward trends, and then you have the downward trends, and then you have the sideways trends. So what we're gonna do is we're gonna try and identify some of those, and able to maybe predict what we do on our options, or recognize a buying opportunity or something like that. So up here you have, well, I'm using E-Trade, by the way. Charles Schwab also has a platform almost exactly like this. Interactive Brokers has a platform like this. These are very good, and the best part is not just the charting, but this Trade Lab up here. Some have an Analyze tab, and we're going to use that for doing options. All right, so I put all up here. This is as far out as it will let me zoom out. Um, so I like to go in from wide to small. Sometimes, depending on what you're doing, you could go way zoomed in to out. But I just want to recognize some trends here and some paths. So I go to the 10 years. So this is 2016 to the middle of 2025. Um, Not a lot of trends. I mean, here's a downward trend, which is lower lows and lower highs. But this is over from 2017 to 2021. So this is over, what, 3 years? It went from $75 down to around 40. That's maybe too long of a trend to look at to actually do anything with. So I'm going to zoom in a little more. Here, right here, this is from 2021 to 2025. This sideways trend right here between 46 and 40 is pretty nice trend line. This you could trade options on. You could start buying and getting your shares, and getting ready for this upward trend here in 2024. And I believe during this period of time, they were battling the Biden administration for Juul. Since Altria is the big dog on the block, tobacco block, then Juul, they were coming after Juul because it was targeting kids and they had all kinds of flavors and stuff. So I believe that's what this is. So as soon as that got resolved, then boom, it popped back up, and you could have cashed in right here from buying these shares. But what's important here is this support level right here. There's a support level at about 40. So when you see it bounce off 40 here, and then it bounced off close to 40 here, it was teetering around 40 here, and then it just turned around and went up. When it bounces off that multiple times, then at some point, whether it's 4 or 5 times, it something really catastrophic is going to happen, and it's going to just get crushed and be below that, and the 40 will turn into resistance. Or when you see it choppy like this for months and months, it could turn around and go right back up, and that's exactly what it did, because it hit 40 here, waited almost a year, hit 40 again right there, then turned around and hit 40 again, and then right here for almost 6 straight months, it was messing around 40, and that's a buying opportunity right there because it's on the low end. This up here, This is a support on the downside where it keeps bouncing. This is what's called a resistance. A resistance is where the stock won't break through. So you see the resistance right here at about 48. Bounced off, wouldn't go over, wouldn't go over, wouldn't go over. Then it went to the downside. And then right here, it broke through the resistance and went straight up to the upside. Okay, and then it never, basically never looked back at that 48 level. So this right here is a great buying opportunity. It's also a great way to, if you own the stock, then you sell covered calls right here, because it's just, if you sell covered calls above this 48 level right here, because we see it bouncing off the 48, bam, 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 and you sell a covered call up here somewhere, you're just cashing in money all the way from July all the way through April of 2 years later. This is a great, because it's moving sideways. It's a sideways trend. It's not going down and it's not going up. Right here, you'd be caught with your covered calls because you'd have to sell here, you'd have to sell here, then you'd have to sell here. So on an uptrend, you want to do cash secured puts down below this 40, because then it'll have to drop below that 40 in order for those to trigger. So here's your covered call area, and then here is your cash secured put area. Okay, so and this is over a 4-year trend. So we could even zoom in further to see maybe some short-term trends if you trade a little closer. Some people do weekly options. Some people do, options that are what's called leaps, which are multi-year. So let's go to the 2-year. The 2-year is, there's nothing you could say about this. This is lower or higher lows and higher highs. So you see these bam, bam, bam. It keeps, every time it hits a high, it's a new high. And every time it hits a low, it reverses prior to hitting that previous low. So this is a very clear upward trend. This creates a channel. If you look here, it is going between 60 or 55 and 5 or 55 and 50 all the way up. So there's a $5 window going up all the way to the upside. And that's a channel that you could take advantage of. Again, on an upward trend, you want to do the cash secured puts, because they're going to, it's basically free money. Right here is our 40 level again. Pops back up. Remember the last time we saw the 40? Let me zoom out again. Last time we saw the 40 was here, and then here, and back here. So the 40 popped up again so this would be a good level right here. If you're unsure, let's say you're right here, June of 2024, and you see it breaking to the upside over the 45, you could sell the 40 here, cash secured put, and then just follow the uptrend up, because the premium follows how close you are to the strike price. And if you remember, the strike price is when the option triggers. Okay, so this is all cash secured put area, and this is over 24 to 26. You could also, if you accumulate shares, you could also recognize anytime it hits between this 40 and 45, then it's a buying opportunity. And then every time you see this reversal right here, then this is a buying opportunity here. Because if you were to buy here, you don't know whether it's going to break down below this 45 or not until you see it reverse and then make this high. Okay, so this would be a buying opportunity right here. And then on this reversal, it hit 50, and then on this reversal, when it turned around at 51, that's another buying opportunity. So you buy, the buying opportunities are on the reversals. Let's go to the 1 year. Okay, this one is a little more choppy. See how it's bigger ups and downs here, and then it kind of consolidates around here. This is a sideways trend. If I saw this, one of two things is going to happen. Well, it's probably already happened. It broke to the upside because here at about 62, it hit and it reversed. This was a hard reversal right here. Hit, reverse, less of a hard reversal, tiny reversal, another tiny reversal, a little bigger, and then it hit again. And look at this tiny reversal here. So it's bouncing off 60, and it's getting more choppy and less time in between it hitting 60. So here it hit 60 and then did a hard reversal, and then here then it did another hard reversal. So this is like 60, 61 is a significant level here. So you can sell covered calls here if you want above the 60 level um, on your shares that you picked up at 40. And what you do then is at 40, then if you want to sell at 60 and you get triggered on that call, then you still made $20 on the per share on each share and collected the premium on the calls. So this is over like a year. Let's go a little shorter. Yeah, see a sideways trend here between 55 and 60. Still looks the same though. We have no new information from here. Let's see if we, nope, still the trend. Yeah, I mean, as I keep zooming in and it doesn't get any choppier. It doesn't tell us, oh, here it tells us a little bit. For a few days, it was between, or actually for a month, it was between 57 and 60. So there was a $3 range here that it was bouncing between. Um, I mean, you you could sell weeklies or monthlies, but I would go a little further out just so you can see trend, because if you look here, you're not really seeing the trends you want to see. You're not really seeing the opportunities that you saw on this year to date one or this 1 year. So this would be a little longer time frame to trade options on, so you can see the upward trends. Um, let's see, 5. Okay, and there's, if you look on YouTube or wherever you get your advice or your techniques, there are literally hundreds of thousands of techniques. Everybody's trying to copyright a technique. I try and keep it simple. These are simple moving averages here. I got the 50 and I got the 200. And then I use significant levels, supports and resistances. And then I use price points to set my points for my options. Now you can do the opposite. Instead of buying stock, holding for the dividend, and then selling options, you could do the opposite and buy the options and then sell the options when they appreciate. So like on the upward swing, then you could purchase the option down here for pennies, and then on the upward swing, it'll get more valuable, and then you could sell it. Or you can wait and have the opportunity to buy the stock. So anytime you sell an option, that you're obligated to do whatever that contract says. Anytime you buy an option, then you have the choice to exercise that option or not. So for instance, if I were to sell a covered call, that means I own the stock. That means that I am willing to sell that stock at a certain price. And when that price hits, I have no other choice but to sell that stock. On the flip side, if I were to sell a cash secured put, I put my cash up and I say, I will buy your stock from you at when it hits this price. Let's say 40. When it hits 40, I have to buy that stock at 40. Which, like I said, if you know your levels and you know your stock, you know that 40 is a deal right here. And it hasn't reached 40 in forever. It hasn't even reached, I mean, it reached 50 almost a year ago. So 50 may be a good deal as well. So this would be where you start recognizing the price points, the important price points, because what the price points are, if you think about it, it's where the big mutual funds, the big pensions, it's where their algorithms or whatever technique they use, they think at that point it's value. So right here, everybody in the world thought it was value because it never dropped below that. And then on the resistance side, people think it's overvalued, and so they start selling it when it hits that point, and that's what causes the reversals. So you can follow what their algorithm is doing even without you going in and analyzing the stock. Because I showed you I use earnings per share. I use other criteria like has to have so much volume, has to be has to have so many shares outstanding, has to have a certain market cap, and that's a way you can evaluate the stock, and that's how all my stocks have to meet those criteria for me to trade on them and get to know them. Um, but then if you just want to be a trader that just looks at the prices, then they're doing all the work for you because right here we know that a bunch of people thought it was overvalued and so they sold. And here they thought it was undervalued and they bought. That's what these trends are. Okay? So, um, let's do some option scenarios. So this trade lab, this is incredibly powerful because what this does is it shows you the um, the risk to reward for options or for anything for any trades. So here you could add options or stock. So if I just want to put add a stock, buy 100 shares at 62.50, and I looked at the strategy. Then I got infinite upside because it could go to the moon. My max loss is 62.25, what I paid for it. My break even, that doesn't mean anything because I just bought it at 62.25. And so it's going to be a straight line to the upside. Anything below 62.25, then I will be in negative profit and loss. And then anything above 62.25 is going to be my profit. Sounds simple, but you have to start off with the simple stuff so the other stuff makes sense. Now, let me add an option, and let me say I sell a covered call at 29, so about 3 weeks out. Now I have the stock. I'm selling a call. Let's say I want to sell it at 65, so I make about a $2 profit. And this would mean I'm obligated to sell when it hits 64 on this date. All right. They will pay me 40 cents, 41 cents a share. These are done in $100 shares, so I make $41 on this deal and keep the stock if it expires, or sell the stock at a profit if it doesn't expire. So let me see, save strategy. Um, Max profit is $216 because it shows me buying the stock, and my break even point is 61.84, which is the amount I collected minus what I paid for the stock, and the risk to reward is 2.03. Now, if you're buying options, this is not a good risk to reward at all. Because think of it this way: if you're buying options, you are getting, those scratch offs that you get at the gas station. You're buying those and hoping that they appreciate because they're cheap and they're easy to um, they're easy to buy because they're very cheap. Now, think of who's selling those. You're selling thousands and thousands and thousands of them, right? These scratch offs. You're getting a little bit of money, but the chance they hit is very, very low. So people are either buyers or sellers, depending on how your personality is, or what your mentality is, or how much assets you have to work with. I'm typically a seller because, like some of you know, I like dividends, and so I have large dividend positions, and then I up the return by selling options on stocks I either want to get rid of or stocks I want to own. Let's look at a different strategy. Um, Covered calls is the least risky. That's because you own the stock and all you're doing is selling your stock at a certain price that you named, and then you collect money for. So let's say we sell a put. Now, a put is an obligation to buy at 62. Here's where my research levels come in. So if I saw that it hasn't been at 55 for 6 months, I may want to do that. And there's no money there. So there's no bid to ask. That means nobody is going to accept this trade. And the reason why is because I put this at August 8th, which this expires in 3 days. Nobody's going to say $55, it's going to hit 55. It's going to go down $12 a share in the next 3 days. That's a ridiculous trade. So let's say September 12th. Give it a little more time. Still not a good bid to ask. And the reason why, again, is that this is a dividend stock, doesn't move very much. So let's do something that has higher implied volatility. Let's see Palantir. Palantir is insane right now. Um, they just were in the news for another like $10 billion contract, but this is crazy overvalued. So let's see what people think it'll hit. Let's see if they'll think it'll hit at 165. So check this out. Actually, let me do a sell. If I sell a put, if I sell a put for 3 days from now at 165, for this to trigger, it would have to go down, what, $6 a share? It would have to go down $6 a share in the next 3 days for it to trigger this. And they're willing to pay me $170 to do that. So that's 3 days, $170. That's because this implied volatility is through the roof, which means people actually think that that could happen. So let me save this strategy, see what my risk to reward is. Max profit is 165. That's how much I collect, and there's an 88% chance that that happens. Okay. Max loss is 16,000, which means that I have to buy the shares, and the shares went to zero, and I still have to buy them at 165. The chances that it goes to zero in the next 3 days is, it says right here, zero. My break even is the money I already collected, 165, minus my minus off the share price I bought it at. So 165 minus the 165, or yeah, it makes it confusing because the strike price is the same as the credit. So if I take the strike price minus what I made, that equals the 163. So anything, if it drops below 163, then I lose this 165 that I collected. Okay, if it stays above 163, I make some kind of profit. If it goes above 165, I make all my profit. And the profit is just what I collected for selling this. Okay? Hope that this is making sense. Let's say I sell a put let's save strategy. If I buy a put at 165, it or then it's gonna cost 168, $168. So see, I'm not on the hook. I'm not on the hook for it going to zero. I'm only on the hook for what it cost me. Okay, and if it goes to zero, my max profit is 16,332 because it went to zero, and I said I would get it at 165. So the chances that I take a max loss, I lose all my money on this, is 88.78%. So you see on the flip side, selling the option was an 88-cent profit on a tiny bit, and this is 88 that my scratcher is gonna lose. And that's about the odds of you playing a scratcher, right? So that's why typically you only need one or two of these to hit for you to do very well. Because look, this can, if this moves by even 10%, which it's already moved by 6%, if this just moves by 10%, this once this profit is going to be massive. Whereas on the flip side, if I were selling this, then I have to hit most of them and not take a loss on very many of them. So there's, like I said, there's two different strategies, and you will figure out which one is best for you. I said I would do a poor man's covered call, which is sometimes called a calendar. So I'm going to add an option. So I am going to sell my covered call, or sell my call, let's say at November for 175. What is it? Oh, that's Palantir. Yeah, look at that's a huge collect right there. Let's go to 180. Okay. And let's go the same date, November, and let's say I'm doing one. Let's say 170, and I'm buying this call. And let's go to save strategy. All right, my max profit is the 525. Max loss is 475. There's about almost a 50-50 chance that I make something, and it's a 1-to-1 risk ratio. So anything below this right here is my losses. Anything above this is my gains. So what this trade is I am obligated to sell the stock at 180. If it hits 180, I don't own the stock. If it hits one, then I have to go out and buy it. But this call that I bought here, these will trigger at the same time, and my loss would be the difference between the 180 and the 170. Which, this is a dumb trade because the one I bought at 170 is more expensive than the one I sold. So for this to be an actual true covered call or true spread, oh, I'm going the wrong way. Never mind. Let's go 200. All right, see, that one's less. So I'm getting credit for 640 right off the bat. If it hits 180, I have to buy it. But here I have a stop loss where I could buy it for 200. So let's see if the risk to reward. So it's 1 to about 0.5. So this is the opposite strategy. This is selling. The other one was a debit spread. This is a credit spread. My max profit is just the 640 that I already collected. There's a 61% chance to that. Your max loss is the spread between the two minus what I collected, because the spread is 2,000. And then your break even is the 186, which is the strike price, minus 640. Okay. Um, do you guys have any questions, or is this all crazy? Mm. So this is pretty short because this was supposed to be added to the last class. So this was the last half of an hour of the last class. Um, yeah, what's up?
Hello, thank you for having class. The question is about the risk to reward ratio. That strategy builder, is that something you can find on this page often? Oh, it's there up in the upper right-hand corner,
Yep.
and it's a
You go
you apply that to every stock, every
every option that I do, then I use this because when when you're trading and you're doing it for a lot of stocks, and because I would put my trades in like a binder, and I would say, okay, what's the stock prices? Where am I going to sell my covered calls? This one is going to be a cash secured put, and I go all the way down. And when you're putting them in, sometimes you don't hit the buy, or you hit sell instead, and then it just messes up your entire strategy. So I put them in here because what you can do is you can build a strategy, save it, and then it will bring up the tickets. Well, I don't have an open account here, but it will bring up the tickets for you to actually execute that trade. So you could execute this trade straight from building this scenario.
awesome.
So you can see your risk to reward, and you can verify, okay, my max profit is 640, my max loss is 1360, but there's only, 20% chance of that. Chances are I'm going to break even, or make a little bit of profit. I'm okay with that strategy. Let me go ahead and hit the trade button right here. And it'll execute, it'll pre-fill both of these in there and execute them at the same time. And actually, let me show you. There it goes. Okay. So here is, if I put them in at the same time, here's my sell, here's my buy. Your mid is 672 is what it's actually trading at right now. And the 640 it gave me was like 10 minutes ago, because I've been on this for about 10 minutes. So it's actually become a better trade. Because see, the mid is 672. So instead of collecting 640, I could actually collect 670, and that's because it's moving so quickly. And there. So this would probably trigger because it's right below the mid.
Hmm.
Yep. Um, so yeah, this would be and this would expire. What's my expiration date? So this would expire November 25th. So this would be in place, bouncing around till November 25th. And what you could do with these is you could buy them or sell this strategy together. So let's say I bought it or I sold it for 640, and let's say that it be it drops in price. This strategy drops in price down to 360. So if I were to buy it, let's say 6 months from now or 3 months from now, it's only trading at like 360. So if I bought back this strategy, I would pocket the 640 minus the 360, and that would be my profit. So you don't have to wait till the strike price or the date in order to get out of the strategy. You could just you could say, okay, I'm good with 70% profit, which is $400. So when it hits $400, then I'll just buy it back, spend 240 and buy it back, and then I pocket the 400. Um, and you could treat these as individuals. So once you bought this strategy and once you see them on your positions, you could treat them individually and buy out of one and sell the other. Because what people do is it's popular where this one that they bought appreciates like crazy. They sell that, and then they keep this one because all this is now it's an unprotected call. Um, or they do the opposite. They'll buy this one back if this one's highly depreciated and just keep this one, and this one turns into a max profit scenario. So let me show you that. Um, so let's get rid of this one. And let's say you just see how just selling that or buying back that call turned this scenario into infinite upside. So if you see it moving against, if you see that call just you know tanking, buy it back, and then hold on to the other one and hope that one appreciates. So you could manage these on a day-to-day basis. You could manage these on a weekly basis, um, but there is so many different strategies out there. Let's do, and here are a lot of the strategies right here on the right. What I used to do as well is I would do an iron condor on the SPX. SPX is the S&P 500 Dow Jones Index, but it settles in cash, so there's no trading of shares back and forth like a traditional option. So whatever the difference is, then they just settle it and they either withdraw money out of your account or they deposit money into your account. And these are usually done like on a daily basis. So this would be where people are doing day trading at, is because these have daily options. So they're trading options on a daily basis, and these are probably the most volatile. So you have the opportunity to make the most money or lose the most money. If somebody's day trading just stocks, they would have to be trading huge amounts of money. Like to make 6%, make this 6% right here. 6% on $50, $200, whatever. You would have to be trading hundreds of thousands of dollars to make this day trading worth it on this, and it doesn't usually trade this way. So this would be like a once in a quarter type movement, and you would have to have hundreds of thousands of dollars on the line just to make any money on it. Whereas if you're day trading SPX, you could make huge amounts of money just in one day, and that's typically what people are doing. Now, what the SPX does, let's go back to charts. We would want to look at the daily on the SPX. This since this is huge, since this is an index, it's not going to help to do like these really long analysis, because there's really nothing to see, because this is 500 stocks in one. So it's not gonna behave like a single stock with the resistances and with the supports and with the price points. So you want to see it on the daily. So this is the daily. Right out of the gate, it hit 63.40, maybe 63.45, and the low for the day is 62.90. So what you would do is go to your trade lab, go to build a strategy, do the iron condor, and this is saying is you're gonna buy a put at the 63.10 level. So I didn't write down what the significant levels were. You're buying a put. This is your downside protection. This is your upside value. This is your upside protection, and this is your upside. So you're betting that the S&P 500 is going to stay between those prices that you've sold at, which is very narrow. So let's say I put this at 6,300, and I put this at 63. Let's say 40. and then I put my stops pretty tight. Let's say 63.25 and 63. Oh, that one's good. Okay, so my credit on this one would be $1,380, and this will settle today. So let me see if I save this strategy. So the max profit is 1380, and that it has to close between these 2 points, and then my max loss is 120, and that's because that's the difference in my spreads, because it's only going to be up above my levels, or it's only going to be down below my levels. It's not going to be both. So one of them is going to be a winning trade. But that's why that this max loss is very small compared to the max gain, is because one of these trades is going to pay off and the other one I may lose at. And there's an 84% chance that happens. And then my break even, I have 2 break evens. One on the upper limit, 63.38, and one on the lower limit. But look at the risk to reward ratio, 1 to 11.5. I'm putting $120 on the line to possibly make $1,380. But you can mess with this. Well, let me go back to build a strategy. You can mess with this and move this out of range. So it's trading at 63.15. So it's already at one of my limits, and I didn't even look. That's why it's such a big reward, because it's already at my limits. So let's make this a little more conservative. Get away from that bottom limit there. So this is, that's the difference between, I went the wrong way. 62. $62.45. So this spread is $30. But the difference between this is only like, well, that's a decent one. So let's take this spread out. So 30 plus 63.25 would be 63.50. So I'm taking less insurance off, which means that this is going to be a wider spread, which means I have more chance to break even. So I put a little more on the line because I spread out my my intervals, but I'm going to make a little tad bit more on it, because what I did was I widened where it can settle at. Now it can settle anywhere between what is this, 60, anywhere between here, which looks like 62.75 and 63.25, and I'll make the max profit. And if we go back to the chart, let's do 63.25 and 63 or 62.75. If I go back to my chart, 63.25 is right here. So it looks like it's creeping up. So that trade is actually gonna work against me a little bit. But on the 62.75, it's not even close to that. So that's working for me right now. So what you can do is you can modify these, and you could go to 63.40 up here with a little bit of protection, and then go to keep your 63.75 on here. And what that does is it widens the area that it'll close at, and you make your max profit. So it'll turn this 19% closer to like 30%, but this max profit will go down. So you can dial in what you're looking for in terms of volatility, in terms of the strike price, which that's your profit area right here, or you could dial in the difference between this 62.45 and this 62.75, because that's a $30 difference right there. You could take that all the way down to $5 difference, or you could stretch it all the way out to as far as you want. All that means is, let's say your strike price is right here and you have to buy at this level. Well, your insurance is all the way down here, and so all of this is your loss potential. Or you could butt your insurance right up against it and limit your losses, but that means your max profit is smaller. Does that make sense? Because the insurance is too expensive. And that's what this 62.45 is. That's your insurance to the downside. This 63.55 is your insurance to the upside. So you got insurance on both sides, and that's what represents the max loss. Is the difference right here and the difference right here. Because like I said, one of these is going to trigger. If it triggers, it's going to be to the upside or the downside. Not both of them are not going to trigger. Is this making sense? So this is day trading the SPX with options. Like I said, if you use the builder, it will tell you what your max exposure is, and it will tell you what your win and loss are going to be. And these are based off delta, which is pretty consistent. It's a pretty good measure. And then your break even's 35. Any questions on this one? Oh, Zuma, did you have another question?
Yes, I did. The insurance bit, how do you know you're covered? Is that something that you reserve prior to trading, or is it
No.
just a component?
It's a component of the trade. So remember, these cells give you an obligation, right? If I have to buy if it hits 62.75, but I get the option to buy at 62.45. So if this 62.75 hits, then I buy it at 62.45 to cover this 62.75. Does that make sense?
Yeah, yeah, it does.
Because so think of it this way. Okay, Zuma, I'm gonna sell you my car for $20,000.
Mm-hmm.
But I already know that guy down there, I could get the car for 17 and sell it to you for 19. Or sell it to you for 20. So I don't actually have the car. I don't have the stock. I don't own the stock.
Right.
I just know a guy that I could get the car from, and then I could sell it to you for 20, and I'll get it to him for 15. Does that make sense?
It does.
The insurance is the car, right? And the profit is the 20,000. You give me the 20,000, I give him the 15, and I keep the difference. That's what this trade is. That's what the insurance is.
Right.
Yeah.
Okay, thank you.
Let's see. It takes some getting used to. This is like anything else where the more you play with it, the more your brain figures it out, and then you can watch the charts here, and you could say, let's look at the last 5 days, 3 days. So in the last, that's 3 days. In the last 5 days, the bottom was 43.79, and the top was 63.50, that's a 2,000 point spread. That's insane. Wait, no, that 43.39 is something else. Is that my trade? That could be what my trade is at. So I can't even see that number. It may be 6,100. So the difference is 200. So you could put your upper limit up here and your outer limit or your lower limit down here, and this is trading right in the middle. So that's a pretty safe trade, but it's probably not going to yield a huge amount of money because it's so far out of the money. It's not even close to the strike prices. Um, this is all your possible strike prices. You could expand this. This is just for, actually, let me do it for today. These are all your strike prices for today, what the premiums are, the bid to ask. In the purple, that means it's already in the money on that side. So these would be out of the money. These would be in the money. These would be, this would be August 8th. So that's the next day. How do I get more strike prices on here? Here's your delta, implied volatility. If you're doing individual options, let's say you're not doing a strategy like this. Let's say you just pick a stock, any stock, and oh, here's my strikes up here. I expanded my strikes. These are all today. So, like I said, if you have your stocks and you're buying them and you're doing options on them, you need to know what the open interest is and the volume. Because if there's very little open interest and there's very little volume, it's going to be hard to get out of that trade, and it's going to be hard to get the price you want. So let's do a GNC. I don't think there's much volume on this. Yeah, look at the volume. There's a bunch of volume right here, which is right at 10, and it's trading at 961. So basically, the only place you could trade this is this $10 strike, either whether it's on the call side or on the put side. Basically, this is the only one in play. The 950 on the put side is in play, and the $10 on the call side, and that's very close to the strike price. So there's very little open interest up here. You're not going to get these prices. But that's only because it's for, is that the, no, that's for the 8th. So that's a 3-day expiration. If you go farther out a little bit, maybe these prices will be in play. I hate these new check boxes. Okay, there it goes. So see how not even, this is a very low traded stock. This is a REIT, real estate investment trust, and there's not a lot of options on these. It's even less interest than the dailies, which is crazy. So this you wouldn't want to trade the options on. Let's look at a high volume NVDA, NVIDIA. So yeah, decent volume, decent open interest. You could trade these pretty easily, and that's all the way out to September. Let me see what the 8th look like. Yeah, see, it even gets closer. A lot of people day trading this. It's 84,000 on the open interest, 150K in volume, and so the calls right here, there's high volume at the call side, which means there's a lot of interest. So which means they're betting against it, and that's what it's doing. See how there's less interest over here than up here? This would be if it's going to the upside, the puts would have more open interest. If it was going to the downside, the calls would have more open interest. So you could see kind of where it's going just based off these. And it looks like this is a pretty popular price. So the 185 is a popular price for some reason, because it's got the volume. There's less volume here and less volume here. So somebody thinks that the 185 is popular or is gonna hit. On this side, yeah, the 175 somebody's betting a lot on, but it's half the volume or half the open interest. Yep, so a lot of negative sentiment on this side, and this is kind of where you could pick up on the negative sentiment, is where are the options playing. And if you go further out, time is supposed to equal more money, because that's what you're doing is you're selling time. The longer your options are in place for, the more expensive they'll be. If you're selling them, expensive is good. If you're buying them, expensive is bad. Um, but out in September, there's still really good volume, and it's right around the strike price. So the 175 is pretty consistent. Let's look at the chart. Where is the 175 for the year to date? Yeah, so I mean they think at this price, then it's pretty. Uh, that's what it's worth. Um, Nvidia, crazy. Since May, all the way to the upside since May. I know I had a cash secured put at 100, and it never triggered. I don't know why I didn't get the buy, why I didn't get it, but yeah. Yeah, sometimes it doesn't trigger, and a lot of times it has to do with maybe there's bigger people, bigger fish out there, and they just didn't, get my trade. Or sometimes it's your broker doesn't have enough pull, and that's what happened to like Robinhood, is they weren't getting their trades executed. They put them in a bind. Um, but yeah, I mean, I've been it's been an hour, and I wasn't planning on going an hour. Um, I hope this is helpful. I mean, you guys can ask me questions anytime if you want to email me or something, or do a booking. Then yeah, we could talk about it. We could talk about your strategies, what you're looking for. Um, but this is pretty niche stuff. As my classes went from simple to more complex, then less people are going to be interested in that. But I'm glad, what, 8 people showed up. Anything else
Indeed.
that I could do for you?
Mm.
Just takes practice. Um, I did. So when I was day trading for a living, oh, I want to show you guys one more thing. Sorry. Uh, let's look at QQQI. So let's say this is too Let's say you're not interested in doing this stuff. These are relatively new, and what they are is, see right here, it says this portfolio is made up of stocks in the NASDAQ 100, and a call option strategy consists of written calls on the NASDAQ. So this is a professionally managed mutual fund where they're selling covered calls on Nasdaq stocks. Nvidia, Microsoft, Apple, AVGO, Amazon, Meta, Netflix. So this is what they're selling covered calls on. So if you have a covered call strategy, then you could use some of these names, which they've already vetted. Or if you just want to buy this and not do any stock, any trading at all, any options trading, this is yielding about 14%. It's brand new, doesn't have a lot of track record, has a lot of volume. Um, has a lot of assets under management. For a covered call strategy at 0.68 expense ratio is very good. It's not trading at a premium or discount, so it's priced moderately. It's priced fine. But yeah, this is a way you could take advantage of options without actually doing the options. The other one is, this is just a covered call strategy. The other one I look at is GPIQ. This is a Goldman Sachs premium income. So they sell options. Premium income means you sell options. This one sells options, but it's not just covered call. It's just derivative income. And it doesn't even say like what it buys. But it says in the name, premium income. It's by Goldman Sachs. It's doing a 10% return. $1 billion in assets. A little bit of a premium, not that much. Better expense ratio. Um, yeah. So again, if you don't want to get very similar, very similar options here, um, I don't know what broad. I don't know why Broadcom is so prevalent in both of these. I'll have to look into that. But yeah, NVIDIA, Microsoft, Apple, Amazon, all the normal players. Um, the 1 year it's made 15%. It's made 25 since inception, which is less than 2 years ago. So yeah, if you want to do option income and without actually doing it, then yeah, these are pretty good choices. Good names. All right, I think that's the last thing I wanted to show you. Any questions?